Big ideas start with a spark. At Tassi's, we use that spark to ignite the fire in ourselves and our kids. So with the trust we build and the knowledge we share, we can grow together and stand tall, creating opportunities to advance in business while setting an example for the next generation. Whether you are starting fresh in Portugal or expanding globally, we're here to support each other. This is more than a network. We are a community that sets the examples for the leaders of tomorrow.
I'm just going to go a little bit more into everyone's background, if you don't mind, because I think when we're talking about the future investing, it really starts with this panel, which is an amazing panel. I'm humbled to be a part of this panel, and talk to you guys. So I'm going to go a little more deep into these folks' background. So Kelly has been investing in early stage technology companies since 2004. 128 companies invested in, 32 exits. He just recently sold a company to CrowdStrike this month for $740 million as part of one of his investments in Moonshots Capital. And Moonshots Capital in his lifetime of investing is 18 unicorns. He's focused on founders who have demonstrated extraordinary leadership. And that is a key to success in life, I think, with anything you're thinking about in investment. Going into Yuri's background, Yuri's a global investor, super connector, and community builder, best known as the founder of VNTR. If any of you don't know VNTR, I highly recommend checking it out. I'm a member of VNTR and very happy with it. It's a premium investor network connecting 5,000 plus active investors across 40 city chapters worldwide. Over the last decade, Yuri has founded and scaled multiple platforms and communities. I'm going to speak more about Antonio's background. Moving on to our last panelist. He is an investor and manager in real estate, tourism, and innovation, and was part of the executive team of one of Portugal's largest family offices. He served as the executive director of Startup Portugal. He is a professor at Nova teaching finance and entrepreneurship, which is great for our kids, as well as the executive director of APCR. And APCR is a private equity and venture capital association. Quick background on me, I'll go very fast. I'm what you would call a retired entrepreneur. I built and sold 5 companies, all in direct-to-consumer marketing and advertising. And over the last 15 years, our family has invested in over 50 companies, more in the private markets than anything else. So I'd say part of my time is investing, but really it's taking care of my kids. Okay? So we'll go into the first question. And the first question, I want to just get right to the points that I think this audience would really care most about, is when we think about the future of investing, what are key strategic shifts that you're making in your investment portfolios today? Whether it be on the venture side, on the family office side, or even with the 5,000 plus investors you're talking with and in your own investments. Whoever wants to go first, maybe Kelly, want to try that first?
Sure. So over the last, I guess now 22 years of investing, there have been a lot of evolutions that have occurred. And as you've heard today by all the panelists, AI is front and center of everything everyone's talking about. And there are kind of AI pure companies, but as important are all the AI enabled companies. So looking at companies looking to disrupt certain industries, brand new industries. Many of your investments, as you think about what you're doing, are how do I get 10% return or how do I get 15% return? For venture capital, where we operate, we're looking for the 100Xs, right? So that's massive, significant return on capital. And you take a lot of shots on goal and most of them miss, like air balls. So we've been looking specifically for Moonshots Capital, a lot of dual use technologies, things that have applications for both the government and the commercial sector. Some of those do involve the Department of War, but others are software that affects federal, state, local government entities. And as Don mentioned earlier, the key differentiator, as you see in anything, is not usually the technology, and it's not always the best technology wins. It's the leadership team that actually is able to execute. The speed of change now is just accelerating beyond belief, and if you don't have a management team that's nimble, like strong convictions, loosely held, we like to say, humble, and like to keep learning, those are the types of founders that we look for.
Very good. Antonio?
Yeah, well, good evening. Thank you for the invitation. It's a pleasure to be here. I totally agree with Kelly when that refers to the the shift that we have seen in the last decade or 2 decades. Invest not in ideas, but in people. So people can adapt, people that can have strong leadership, and people that can face the changes that the world is going through. So I think that is a big shift. Also, depending on the risk-taking that you are willing to have, I would say that there's the passive way of investing. You can allocate your assets under management to professionals that do it, and they go to public markets and they invest in a diversified portfolio in shares and bonds and liquidity and all that. I would say that the real value, and this is the second shift that I would point out in the last decade, I would say the real value is more on the private side currently than on the public side. I would say that the real game changer companies, they allow investors to reach high profit and high multiples, like the ones Kelly was referring to, when they are private, when they are scaling up, when they are going abroad and international, and when they have their product confirmed by the clients and by the market. That's the real value potential, and more I think today a good strategy for investing in good teams, leadership, where you can bring also some knowledge to your investment, not only passive way of allocating capital to a company and waiting like a typical old school financial investor. Currently, I think there's more than capital on the table, and you should bring also knowledge, network, and ways of contributing to the project. And this also requires some effort and some time from the investor side. So it's not just a question of allocating the money, it's also a question of bringing value besides the money. So I say that is also a fourth shift that I witnessed in the last years. Yeah.
I like it. Yuri, you're up.
Cool. Thanks for hosting. So we run global investor community, and we have different types of investors, from experienced GPs like Kelly to family offices to angels to LPs to CVCs. So there was a lot of shift in the past, let's say 3-4 years, and I'm sure Kelly is experienced that there was less appetite for family offices or capital allocators to invest in VC, right? Because it's 10-15 years you wait for liquidity. As a result of that, high net worth individuals look for other asset classes rather than venture capital, or they invest in late stage, pre-IPO, where time to exit is 3 to 5 years, or sometimes even within 1 year, right? So like you guys invested in SpaceX recently, so with hopes to exit within the next 12 months, right? Yes. We see a shift that high net worth individuals, they either want to invest direct or not invest in venture at all. And there are lots of alternative assets, there is a boom in DeFi, right? It's kind of digital, kind of decentralized finance, and it matures. And there are some trusted vehicles where you can generate good yield. We see that some investors prefer debt financing, where it's more liquid. Hedge funds. There are lots of algorithmic trading hedge funds that show good returns. As a result of that, high net worth individuals prefer to more liquid, short term, still with the same kind of performance like investing in a VC fund, but shorter term and more liquid.
Very good. I like all the answers, actually. And yes, we love SpaceX, we love XAI. Those are all really good ones. I'm going to move to the next question, which kind of you started to answer, and it's a separate question. But given the current macroeconomic, not macro-political, but focusing on economics, the environment, do you think that traditional asset allocation model, mainly stocks, bonds, real estate, is it still viable, or is it time to rethink the framework entirely or edit from there? What do you think about that? Kelly?
So the answer to that probably depends on where you are in your kind of career or wealth building life cycle. Maslow's hierarchy of needs is super important. If you've kind of taken care of everything and all you're thinking about is how your money's working for you, and you're less, I'll call it risk averse, and kind of 10 to 12%, 15% on a good year is what you're interested in, some portion of your asset class should probably be able to take advantage of the highest performing. Like Yuri went through some of them, but early stage technology has over time, notwithstanding some crypto craze, really outperformed other asset classes. And I think that's still going to be the case. But you have to decide what kind of your risk appetite is and where you want to access it. But I think the most important component, though, is you have to be in deal flow. You have to be in the mix. And if you're an angel that's looking to learn, you're very interested in a sector and you want to meet the founders and get engaged with the community, you can buy onto a cap table. It might not be a killer company, but you'll be able to engage, add value, use your network. And part of what you're getting is that experience, not just the financial return. But if you're investing in early stage tech for a financial return, it's very difficult to do and do well if you're not in flow. As an example, our fund 2, we saw 5,019 deals and we invested in 18 of them. And that's not that much of an anomaly. Venture funds, people who are in the flow, get to see that many deals. So if you think about, if you go to 2 or 3 investor dinners, see 4 or 5 companies present, and clearly one's going to be better than the other, and that you get excited and you invest in that founder. You do that 2 or 3 times over the course of a year. By the end of the year, the first one you invested in went out of business. You're going to stop investing as an angel. You're going to be like, uh-oh, all this is at risk. I'm going to stop. I've lost all my. You're going to do it, or your significant other is going to tell you can't do it anymore, or whatever. And you really need to get to 20 to 25 shots on goal. That's the Monte Carlo simulation show that angels need to invest that many bets. So and I'm not a financial advisor as it relates to your entire portfolio. I understand this asset class. So if your appetite for risk is high because there's big alpha in this venture capital early stage tech, and let's say you have $1 million that you can put into that, you need to split it into 20, 25 bets and either give it to a capital allocator that's in flow, or do a lot of homework and try to work really hard and get in flow so that you can look at all the deals. And I would say 20 of them you leave up to the experts, and 5 of them you scratch your I used to be an entrepreneur itch, and I want to get in and help the founder and learn more about the industry, whatever it might be. But that's what I look at. And so answering the question, I'm not qualified to tell you what percentage of your portfolio that should be, and it will depend on you individually. But for this asset class that performs very well, I think that's how I would approach it.
Yeah. And Toni, what do you think?
I think traditional asset allocation and asset classes are still valid. Maybe more for preservation, more for keeping your wealth and your assets well managed, okay? But if you have the time and if you have the attitude and you have the availability and the ambition to make some more profit, I think you should go to other types of new alternative investments. I would say that, well, if you don't have much time to allocate to this activity, maybe join a micro fund. Totally agree that in 20 targets, in 20 companies, typically business angels that are investing, 2 of them will pay for the whole portfolio, and maybe the other ones will go out of business. So be prepared for failure, because it's part of it. But if you do it in this way, it will pay out. And in Portugal, well, I can bring some knowledge to you about what we have in Portugal. We have quite interesting supporters of this activity. We have an association that is called APCRI, that I'm a board member of. It's a Portuguese association for venture capital and private equity. You have also another association for business angels, which is called Investors Portugal. that has almost all the business angels that work in Portugal, that develop their activity in Portugal as members. You also have a network of 130 incubators all over the country. It is managed and coordinated by Startup Portugal. So it's quite a big number comparing to other European countries. In these three entities, APCRI, the Portuguese Risk Capital and Venture Capital Association, Investors Portugal, and the National Network of Incubators, you will find certainly people, experts that will help you not to be alone in your activity, in your way of doing some direct investment. And again, do not pick one by one, totally agree, because you will be frustrated, because the majority of the high percentage of probability is that they're going to fail, but pick a small portfolio, invest together with others, and try to earn some multiples of profit from there.
Thank you, Antonio. Yuri.
Yeah, I will add on top of what Kelly shared about how to invest, right? It's kind of, you mentioned let's split it to 20 deals and learn from it, or be active and hands-on. We see that lots of these angels, they lose money in the first 10 deals and stop. This is true. Another good practice is because the market of VC it's very hard to raise money for a VC from high net worth individuals, not like years before. And you approach Kelly and he will definitely take your money, and he will show you how to do it right? So best way is to join one of the funds as LP and learn by watching, right? It's kind of, and one of the cool things that GPs offer you is co-investments, and you can co-invest in the best deals while you have certain amount diversified, because Kelly will invest in, with his fund in 50 deals, and it's diversified portfolio, while you can co-invest in the best, right? Through a syndicate, or many GPs, they offer co-investment rights directly into the companies. So this kind of one way we recommend newbies in VC to start in VC. You join forces with prominent VCs, and most of the VCs today, apart from maybe top 10, you can deploy money with $500,000 as LP these days. So you just ask ChatGPT what are the best GPs in Portugal, and you approach them and they will take your money, and then you co-invest with them. The other aspect we didn't touch is there's a lot of people saying the VC model is dead, right? That, hey, why should I pay management fee to Kelly to invest in companies on the whole fund size, right? Or committed capital? It must change. So nobody says how it should change, what should be the model, right? So this is another topic we can discuss.
To reinforce hello, Gabi? To reinforce what you both touched on. So we came up first as I was an angel investor, then we started running syndicates, my co-founder and I. Syndicates are where you create a special purpose vehicle to invest in one deal. And you say, okay, I met, Yuri's a killer entrepreneur. This is his third company. He's definitely going to be successful, and he's not going to have any problems raising money. And Yuri's like, Kelly, I'd really like you on the cap table. I know your network's going to help me. How much can I put you down for? I'm raising $5 million. And if I'm running a syndicate, my answer is somewhere between 500,000 and 2.5 million. And I get a quizzical look, and he goes, well, when will you know? And I'll say, somewhere in 2 to 3 weeks, I might have a direction, because I have to go out to all of the angels that invest through me and say, 1, are you there? Or are you in Fiji not answering the phone? 2, this is the deal. This is why I like it. This is how much money I'm putting in. How much do you want? Collect all the money, put everything, and invest. We have invested over 70 million through those types of vehicles, those types of syndicates. And we have investors who decided to approach working with us only through the deals they liked.
Yes.
And invariably, after 4 or 5 of them that were the ones, and we put money in every deal, so we wouldn't ask somebody to put money in if we don't do it, and personally. And so invariably, they say, hey, how am I doing all mine? And we pull which ones they did, and it's like four of them that didn't work out. But if they'd done the fund, like we're returning cash and performing. But there are also some angels who picked the 4 that went bananas and didn't get in the other ones. So it works both ways. It depends on how much you want to be involved, which is what you were saying earlier.
Yeah,
and it's a good learning experience, right?
Let me add something to the topic that Yuri raised. It's very interesting because the VC is their current way of thinking. Well, I think it's not a threat for the investor because VCs and GPs, which are the managers of the funds, they are more and more professional managing the funds. So they are really proficient doing that, and they pay higher and higher multiples. I think it's a risk and it's a threat to pipelines and to the diversity of companies where they can invest. So I agree with Yuri, diversity and the quality of the pipeline, not the ability or the proficiency and the professionals that manage the funds. So I think it's not a question related to the investor side more than to the pipeline.
Yeah, and just to add a little more, because I love what everyone's saying, but to add a little more context, I mean, diversifying your portfolio, and I want to also disclaim for this whole group, we are not certified financial planners here. We are all entrepreneurs, all investors. So we're giving you what we see has worked for us and what we see in the ecosystem. I think everyone here is fans of cryptocurrencies. Stable coins would be a fair thumbs up on that. Fair on AI, on some relativity, some in robotics as well. But diversification is, I think, an important point to take away from here, is that the question is how much and at what point in your life. And then if it's your child's college education that you're thinking about and they're graduating in 7 or 8 years, then maybe you can afford a little more risk than your traditional returns in stocks and bonds, mutual funds, et cetera. So that would be a fair closure here. But yes, big fan of syndicates, yes.
I think everyone's looking for getting that first check into it, whatever the new Google is going to be.
Yes.
That's the allure for sure, and that's what you read about or hear Jason Calacanis talk about his first check in Uber, if you listen to the All In podcast. One thing that I've seen over the years is that, again, depending where you are and what your objectives are, like if you are going for creating a massive amount of wealth, anyone who I've seen who's done that has usually done that through some type of concentration. Whether it's all in on their own companies, a la Elon, or it's all in on, I'm putting all my money in early on this Bitcoin weird thing from 2012. Like, it requires a different type of conviction if that's what you're going for. If you're going for that type of multiple return with what you're doing, then you have to invest with conviction, whether it's your own time or it's your money. But again, it depends where you are in your life and what you're going for.
Okay. Last question. I want to make sure we leave on time here. So if you can answer quickly, that'd be great. In the new era of AI and agentic or agent-based tools, how has technology changed your investment process?
It helps because it brings some efficiency, some quickness, but it doesn't replace the judgment and the own individual criteria that we still have to have. But it helps in the process, reviewing some aspects, some investment memorandums, some contracts, something. I would say that like a lawyer officer that I know, a partner of a big lawyer company in Portugal, it maybe replaced kind of a first-year lawyer, junior lawyer level, but it doesn't replace at all mid-scale lawyer, and you have to have your own judgment and your own critical view on the things.
Very good. Kelly?
So for the major muscle movements of a venture fund, there are kind of two strategies. One is spray and pray. So you put little checks in as many companies as possible, and then there's no way to really help those companies because you're so spread thin. We're on the up, and that's a fine strategy, and that's how you can hit a Google. But we are fewer checks, but larger checks with conviction. And so it's really important, our selection process on the front end. So we use AI and agents for sourcing, scouring, for looking for our criteria to take a lot of the grunt work off of the front end.
Yeah.
In fact, 1 or 2 humans probably even couldn't do all that grunt work. So it gives us more exposure to deals on the sourcing side. Then we have a platform. We like to call it a platform. We're working on making it a platform, but for helping the companies. Once we put the money into the company, then we help them. We actually engage with introductions, employment, like all different elements, right? We do heavy lifting with those founders. And there's a lot that you can do with AI or an AI-enabled software to help those companies. So we're using it more and more every week. I just hired a head of platform and content who's an expert and has been building tools for VC funds that use AI to make their processes more efficient.
And Yuri, how does that apply to your business?
I would touch from different perspective. So AI and agents precede that. If you meet an entrepreneur that didn't build something inexpensively using AI agents and didn't validate their business model by himself, then you shouldn't invest. Because it's so cheap now to build something and validate your idea. There are tools to build software, build processes. One person can build a working business and solution, right? So same like VCs or investors can use these tools. We expect entrepreneurs to use these tools and build the initial product themselves without technical co-founder, without a team, and sell.
The criteria has gone way up for what you're going to invest in.
And as a result of that, Kelly is needed at Series A or late seed when the business is already up and running.
So just want to close out, but if anyone's interested, we're going to have fun tonight. We're going to go to the Venture House, which is 2 blocks away from out here, to enjoy dinner. Do you want to tell them a little bit about the event?
Sure. So we launched an exclusive membership club next door called Venture House, where we created a clubhouse for high net worth individuals, exited founders, successful investors. And it's like Soho House meets YPO for investors. And we would love to have you at our after party. We partner with the conference with Toni and Alyona to have fun. And we'll have a live performance by semi-finalists from The Voice Portugal. Wow. And we'll have a DJ and good food and drinks. So join us.
Thank you, everyone.